Proprietary trading firms. What are they? Are they a scam? Are they a wealth creation engine? What on earth are they? In my quest to increase my own personal wealth and to sort of explain personal wealth creation to the people that I know and love and to general strangers on the internet, I've been doing a lot of research on different types of platforms and trading funds and investment platforms. And I came across something that I had not seen before. Now, I've heard of hedge funds, I've heard of index funds, I've heard of mutual funds, and I know what all those things are. Upon further research, I came across a different type of fund, a different type of firm, actually. A proprietary trading firm, or prop firm for short. And I'm thinking to myself, like, what is this thing? They make all kind of wild promises. Being able to keep 90% of the profits that you generate while doing trades for them. They also seem to have a very restrictive entry requirements. What are these proprietary trading firms? Do they have different trading algorithms that they use, or what exactly are they? I'm going to explore what they are in this video. Hopefully, we all learn something together. And my research can help you to determine whether or not you want to engage in and with a proprietary trading firm, if you have the talent, apparently. In any case, like and subscribe, click the notification bell if you want more great videos just like this. I'm Derek West for Finance Squared. Welcome to the journey. Prop firms or proprietary trading firms are companies that use their own capital to trade financial instruments on the open market. They are not tied to any particular client, nor do they have any obligation to a particular market maker. Instead, these firms are focused on maximizing their own profits. Prop trading firms typically possess a large amount of capital, which allows them to trade in a variety of financial instruments. This allows them to take advantage of opportunities that may not be available to other investors. They often have access to more information than most investors and use sophisticated quantitative techniques to make trading decisions. They are often able to take on more risk than other investors, as they are not tied to any particular client. Prop trading firms typically employ a team of professionals to manage their investments. These professionals are responsible for researching market conditions, identifying possible trades, executing on those trades, and managing risk. In addition to that, they're often responsible for creating and implementing trading strategies. These strategies can be tailored to fit the firm's risk-return profile, as well as its overall investment objectives. Proprietary trading firms are usually regulated by government agencies such as the SEC. As such, they are required to comply with certain standards when it comes to trading. This includes maintaining adequate capital, trading within certain limits, and reporting any trades to regulators. Additionally, prop trading firms must also adhere to any applicable insider trading regulations, which is all well and good. However, I'm wondering, how are prop firms different than mutual funds, hedge funds, or index funds? What is a proprietary trading firm, and how is it different than a mutual fund, a hedge fund, or an index fund? Proprietary trading firms are different from mutual funds, hedge funds, and index funds in a couple of different ways. Mutual funds and index funds are investment vehicles that are available to anybody and are typically limited to long-term passive investments. There are examples out there where that's not the case. As a matter of fact, index funds have been expanding more and more in recent years into more exotic instruments of various kinds. But typically, they are limited to long-term, growth-centric investment vehicles. Hedge funds and proprietary trading firms, on the other hand, are reserved only for wealthy individuals and institutional investors. Hedge funds employ aggressive asset management techniques and complex trading schemas to improve performance, while prop trading takes position in interest rate and credit products, mortgage-related securities, asset-backed securities, commodities and currencies, and a variety of other instruments as well. When it comes to fees, hedge funds are typically charged a percentage of the assets managed, while prop trading firms benefit from direct market gains, as prop trading firms are really not beholden to any investors per se. The proprietary trading firm, well, they're trading their own cash, whatever cash that firm has in its bank account. So it benefits directly from the market gains. The thing is, it promises its traders that they'll get over 50% of the gains that they make. In some cases, as with FTMO, they promise as high as 90% returns for the investor, while the prop firm, FTMO, gets 10%, which is an interesting split to me. We'll explore that a little bit further later on in the video. So if we dive a little bit deeper, proprietary trading or prop trading is a type of trading which involves taking financial risks and making an investment directly with an investment firm's own capital, instead of on behalf of a client. It usually involves actively trading in financial markets to generate returns and profits for the firm. Prop trading typically involves making numerous trades with the firm's own funds rather than those of a client, and the traders may be compensated in part by the profits made from successful trades. Prop traders, they use various strategies such as market making, momentum trading, arbitrage, and even event-driven trading. These strategies involve taking positions on a wide variety of financial products, including stocks, bonds, derivatives, commodities, currencies, etc. We talked about that a little bit earlier, with the intent of generating short-term profits. Prop traders typically work in small teams, often with a designated risk manager, and are usually required to have a high level of financial knowledge. Prop trading has become increasingly popular in recent years, and many banks have set up dedicated trading desks to engage in this type of trading. A question one might ask themselves if they're interested in proprietary trading firms is, how can a trader, if you were to become one, make money with a proprietary trading firm? Traders at prop firms typically make a share of the profits earned from successful trades. The exact percentage of the profit varies from firm to firm and is dependent on the trading strategy employed. Prop firms generally have two business models: the challenge model and the profit split model. The challenge model involves traders paying a fee to the firm in exchange for the opportunity to trade, while the profit split model involves the firm taking a cut of the profits traders make each month. Traders may be eligible to receive around 20 to 50% of their profits in the form of a bonus or a commission, depending on their level of success. Some firms, such as FTMO, have even proposed offering over 80% of a profit sharing split. This gives prop traders a great incentive to take on more risk and attempt to make larger profits. Like I mentioned before, FTMO, they become somewhat famous on the internet for their profit split model, where a trader can make up to 90% profits and they, the prop firm, keep 10% if you, the trader, manage to trade in the black and stay profitable. Prop firms will give proven traders funded accounts of up to $200,000. I've heard some anecdotal evidence of prop firms giving $400,000 to $1 million in funds to trade with, and in some cases keep 90% of the profits. But that begs a question. Does it make financial sense for a firm of any kind to only get 10% return on their investment? Let's think about it in a different context, if you will. If you put $200,000 into Robinhood and you purchase an index fund and the index fund gained 8%, would you then be happy with 10% of that 8% profit? Would you not be mad that Robinhood is keeping 90% of your gains and you only get to keep 10? Perhaps that is too simplistic. Perhaps because index funds that track the S&P 500 as an example are too conservative for a proprietary trading firm's algorithms and risk tolerances. Maybe there are artificial intelligence algorithms that are used to great effect that can give you back 20% or greater returns from the markets and the indices that they track. Would you still be happy with keeping just 10% of that consistent 20% gain? So 20% of 20,000 is $40,000. 10% of that is $4,000. So a $4,000 gain for the original investor on the holder of the account who invested $200,000. Seems a little fishy to me because effectively the prop trading firm is giving $36,000 to the trader. It seems as though the holder of that money would simply just be better off purchasing an index fund or an ETF and keeping 100%, minus taxes and fees of course, of the profits. Again, on a $200,000 investment in an index fund with a generous 10% gain. Keeping the math very simple. The holder of the cash would make $20,000 as opposed to $4,000 for lending it to a quote-unquote prop account. And this takes us to an advertisement that I saw on the YouTubes while doing research for other investments. There was this advertisement for something called the Infinity System, founded by a man called Jonah Armstrong. Apparently he came out of retirement from a software company he created to found this new trading, let's call it a scheme. And what they do, the service that they provide, is that they have a done-for-you system where they have someone or some AI tool pass a prop trading firms, FTMOs in this case, they have them pass their assessments and their rigorous trading tests. They then give you, the purchaser of the account, the purchaser of the Infinity System, they give you that account for you to then use an AI trading bot or an algorithmic trading utility. These have been around for decades now. This is not something that's just risen up with ChatGPT or anything of that nature, but they give you algorithmic trading utility that then trades on a specific market using a specific strategy, enabling you, the purchaser of the Infinity System, to generate passive income anywhere from low 4 figures to high 5 figures, all for a measly $2,500 in an investment. Seems like an interesting way to make a little bit of extra cash. And this loophole is using algorithmic trading bots in place of actual active trading, enabling you to essentially do nothing while the AI executes all the trades. There are caveats for that, as there needs to be some place for the AI to execute its logic, and obviously it needs to have access to the account which it will be executing the trades with, and it will need access to the market upon which it will trade. All those things cost money, which explains the monthly charges that Infinity charges you, the Infinity System holder. The claim is that they have safe profits, and their bot only trades on Tuesdays through Fridays during Chinese market hours. So basically you're investing in one of the Chinese stock markets, and based upon the literature on their website, it's still not clear if the market is the Shanghai Stock Exchange, the Shenzhen Stock Exchange, the Beijing Stock Exchange. Maybe it's a stock market with less ethical and political questions, such as the Hong Kong Stock Exchange or the Taiwan Stock Exchange. These questions have been left unanswered so far. Leaving aside the political question for just one moment, how can one expect quote unquote, safe profits from any of those stock exchanges? They seem like they would be ripe for volatility, given some of the issues that are popping up in China right now, all of which are outside the scope of this channel, except to say that making money in China is a very dicey proposition. But all that for $2,500 at checkout. and an ongoing $500 per month to be part of the system, and $980 in addition to that to take the prop firm's evaluation test. And that's not all, folks. $30 per month that you owe them for the virtual private server, whether it's AWS, GCP, Azure, DigitalOcean, wherever. This is going to be where your trading bot will have access to execute trades, one assumes. It's going to need to be a beefy virtual private server, as AI requires a lot of resources to execute effectively. The claim is that you should have $10,000 in profits after your first 7 months of being live. And should your trading bot lose money, apparently there's no obligation to pay any losses out of your profits. Another interesting scenario, which is sort of hard to believe. But the worst case scenario is that you would lose the account in FTMO, and you would simply make a new account. This to me would seem as though on the scale of 1 to 10, on the scam-o-meter, about a 6, with 10 being not a scam at all, and 1 being super scammy. The methodology that is being proposed by this guy seems like it is legit. The prices that they are charging for their system seems like they're a little bit high. The rewards that they're promising people who purchase into their system also seems slightly unrealistic. As anybody who's used algorithmic trading would tell you, algorithmic trading is as subject to volatility and losses as any other type of trading. AI and algorithms, they're not magic. They can't predict the future. They're really good at doing mundane tasks and researching past profits and researching past patterns. Establishing new patterns and predicting new patterns in the future, that's still something that needs to be improved upon. And to be honest with you, there's probably never going to be anything that's going to 100% predict something as complex as a stock market, for example. I say all that to say, like $2,500 plus the $1,000 for getting someone to pass the prop firm test, as well as the ongoing monthly fees. Seems a little bit steep for what the true value proposition of this thing is. The true value proposition is getting someone to pass your FTMO assessment test for you, and also to give you a trading bot that works. That to me seems like $1,000 tops. I'm not gonna assume that this guy's system is a 100% total scam. It does in fact have some legitimacy to it. The only question I would have for these guys is, do I have to trade in Chinese stock markets? Can I use NASDAQ, the New York Stock Exchange? Heck, even Euronext. Any of those would probably be better than a Chinese stock market. Maybe this is the one market on earth that this system can work in. Who knows? One thing I will say for this system that you should probably be aware of is that you pay $2,500. Let's just say that's the amount that you pay to get into the whole program. And this guy says he wants about 2,000 individuals into his program. So if 2,000 people sign up at $2,500 a pop, not including the other fees, this guy gets $5 million, and you get maybe $10,000 a month in profits if it works out for you. I'll say it's a very good system for him. It might not be that great a system for you. In any case, that's an interesting exploration of this system, the Infinity system. This has also been an education for me about proprietary trading firms. This is something that I'm going to be looking more into as time goes on throughout the year to see if it's really something that I should focus my attention on at all. So if you want to be on that journey with me, like and subscribe, click the notification bell for more great content similar to this. And remember, a goal without a plan is a wish. A goal with a plan and no action is a wish list. I'm going to get out of here, guys. I'll catch you next time. Peace.